Ethical dilemmas in accounting aren't just theoretical. They're real, challenging, and happening every day in businesses around the globe. On any given day, accountants and auditors experience ethical dilemmas, and the solution isn't always immediately clear. In this video, we'll talk about how to best navigate these difficult situations. Solving ethical dilemmas in accounting consists of these 4 steps. The first step is defining the moral values that should guide our ethical actions, and then as part of the second step, we identify those who are or may be affected by our actions. In the third step, we analyze each possible action using moral reasoning, and last, after pondering all the available information, we make a decision. In this video, we'll start with the first step of defining the moral values and talk about the accountant's responsibility to always put the public interest first. The importance of integrity, why being ethical is not the same as following the law, the 6 pillars of character, and various modern philosophies such as teleology, deontology, and virtue. So what exactly is ethics? Well, it's all about how people should act. Think of it as society's playbook for acceptable behavior. It includes the standards we live by, the practices of various professions, laws, and what society expects from us. But let's be realistic. Being ethical isn't always easy. Some people, no doubt, prioritize their own interests over doing the right thing, and there are plenty of pressures to stray from the ethical path. Understanding ethics and its goals can seriously shape how we act. For accountants, ethics are like the backbone of the profession, built on safeguarding the public interest, and unlike many other professions, accountants put the public's best interest first. Take lawyers, for instance. They usually prioritize their client's interest over disclosing potentially harmful or illegal actions. But accountants face ethical dilemmas too. We've all heard of financial scandals and misuses of funds. Sometimes even good people like Betty Vinson, who was part of the WorldCom scandal, can get swept up in fraud. That's where the concept of an ethical blind spot comes in. It's that gap between who you want to be and who you actually are. Under pressure from organizational goals and compliance systems, our ethical reasoning can sometimes take a hit. A person with integrity, however, will stick to their moral principles even if it means risking their job or client. In the world of accounting, the public interest should always come first, ahead of personal or client interests. And that's sometimes easier said than done. An ethical fading can easily occur when ethics take a backseat to other considerations, leading to actions that might not align with your moral principles. So let's now talk about integrity. Integrity is the quality of being honest and having strong moral principles. It's about consistently doing the right thing, and even when it's difficult or when no one is watching. This is especially important in professions like accounting, where trust and transparency are so important. The concept of integrity has deep roots in ancient Greek philosophy. Socrates, Plato, and Aristotle, 3 of the most influential philosophers, all emphasize the importance of moral virtues, including integrity. Socrates, for instance, believed that knowledge and virtue are intertwined, famously stating that an unexamined life is not worth living. Plato, a student of Socrates, expanded on his teacher's ideas. He believed that integrity is essential for the well-being of both individuals and society as a whole. Aristotle, Plato's student, introduced the idea of the golden mean, which is the balance between extremes. And according to Aristotle, integrity involves finding the right balance and acting with moderation, guided by reason. He saw integrity as a cornerstone of ethical behavior. Ethics and morals both relate to distinguishing right from wrong behavior, but they aren't quite the same. While they are sometimes used interchangeably, there are key differences. Morals concern principles of right and wrong in general, whereas ethics relate to right and wrong conduct in specific situations. Moral principles include always telling the truth, not cheating, treating others fairly, and being kind. Morals are customs established by groups of individuals, reflecting what a society believes people should do. On the other hand, ethics define the character of an individual. Ethical principles include truthfulness, honesty, integrity, fairness, respect, and loyalty. Ethics are guiding principles that help individuals or groups decide what is good or bad. While morals represent the general rules and beliefs of a person, group, or society, ethics are more abstract and require context to determine what is right or wrong. It's important to note that being ethical isn't the same as simply following the law. The existence of laws prohibiting certain behavior won't stop an unethical person from violating them. Laws set a minimum standard of behavior, but ethical individuals usually strive to go beyond these standards. The Josephson Institute of Ethics lays out the 6 pillars of character, which are key principles to guide us through the ethical decision-making process. These pillars are trustworthiness, respect, responsibility, fairness, caring, and citizenship. Josephson suggests that these 6 pillars act as a kind of multi-level filter for our decisions. It's not enough to just be trustworthy, we also need to be caring. Similarly, simply following the law isn't enough either. We must also take full responsibility for our actions and even our inactions. Trustworthiness means being honest, acting with integrity, and being someone others can rely on. Loyalty is a big part of this too. It's about doing the right thing for the right people in the right way. In accounting, this is especially critical since public interest is always at the heart of what we do. Respect is all about treating everyone with dignity, no matter who they are. Responsibility means thinking carefully about your options, sticking with the tough decisions, and following through on your moral duties. Fairness means acting impartially, treating everyone the same, open to different points of view, and avoiding bias. At the core of caring is empathy, understanding and being sensitive to the feelings of others and showing genuine concern for their well-being. Finally, good citizenship means being a responsible member of society. This involves obeying the laws, staying informed about current issues, volunteering in your community, and exercising your right to vote. The ancient Greeks believed that reason and thought precede the choice of action and that we deliberate about things we can influence with our decisions. Basically, think before you act. It sounds simple enough, but really, how many times have you encountered situations where people acted before thinking? The ability to reason through ethical dilemmas and act on moral intent is a critical skill to make ethical decisions. We have all of the best intentions, but then peer pressure, boss pressure, and perhaps a company culture that always sides with the client's interest rather than the public interest. For example, accountants know inventory obsolescence should be recorded at year end. But what if the client insists on holding off on the write-down due to concerns about a low level of earnings? Will you stand by your moral principles? Will you satisfy your obligation to honor the public trust? Or will you go along to get along and be a team player? Moral philosophies give us the tools to figure out what's right or wrong in different situations. There are plenty of these philosophies and they can get pretty complicated, but here's the catch. There isn't one universal moral philosophy that everyone agrees on. For now, let's focus on the basics. You'll need to handle conflicts in the accounting world, and later on we'll dive into the ethical standards found in professional ethics codes. In teleology, the idea is simple. An action is considered morally right if it leads to a desired result. whether that's pleasure, personal gain, fame, utility, or even wealth. Two big players in teleology are egoism and utilitarianism. Egoism is all about putting yourself first. It says that the right thing to do is whatever maximizes your own self-interest. Ethical egoism takes us a step further, claiming that promoting your own well-being is actually a moral duty. But here's the thing, in the world of accounting, ethical egoism doesn't cut it. You can't just ignore the public interest for the sake of your own interests, like going along with a client's wishes if it could harm others. Then there is enlightened self-interest, a concept that Alexis de Tocqueville talked about in Democracy in America. The idea here is that people often work together in groups to benefit everyone because by helping others, they ultimately help themselves. This kind of egoism has value in accounting. In this case, looking out for the public interest is actually in your best interest too. Now let's talk about rational egoism, also known as rational selfishness. This philosophy says you should act in a way that always maximizes your own self-interest. Ayn Rand, a famous contemporary philosopher, was a big advocate for this. According to Rand, people must choose their own values and actions to survive and thrive. However, when it comes to accounting, the ethical standards of the profession aren't up for debate. No matter how rational it may seem to put your own interests first, you've got to adhere to the professional code of ethics. Like egoism, utilitarianism is all about consequences. But here's the twist. Instead of focusing on what's best for you, utilitarianism aims to create the greatest good for the greatest number of people. Utilitarians have a clear step-by-step approach to decide what's morally right in any situation. First, they figure out all the possible actions they could take, then they weigh the benefits and harms of each option, choosing the one that maximizes the overall good. While utilitarianism is a popular ethical theory, it's not without challenges. The main hurdle is that utilitarian calculations often require us to measure and compare the benefits and harms of different outcomes. And let's face it, sometimes it's incredibly tough, if not downright impossible, to assign values to things like happiness, pain, or long-term benefits. Now let's turn to deontology, a moral philosophy that comes from the Greek word deon, meaning duty. Unlike utilitarianism, which looks at the results, deontology is all about focusing on rights and intentions. The key idea here is that every person deserves equal respect. However, deontology can run into trouble when the rights of two parties conflict. In accounting, for example, you may face situations where you have to balance the rights of different parties. In those cases, your duties and obligations to each party outlined in the AICPA Code of Ethics should guide your decisions. And remember, the rights of investors and creditors should always take priority, even if it means setting aside other obligations. One of the most influential thinkers in deontology is Immanuel Kant, 1724 to 1804. Kant believed that every individual has intrinsic worth and dignity, and we must respect that no matter what. When we talk about justice, we're diving into ideas of rights, fairness, and equality. A just action is one that respects people's rights and treats them fairly, ensuring everyone gets what they deserve. The ancient philosopher Aristotle laid down the cornerstone of justice over 2,000 years ago with this principle. Equals should be treated equally and unequals unequally. In simple terms, people should be treated the same unless they differ in ways that are relevant to the situation. Finally, virtue theory sets itself apart from the other philosophies by focusing on both the person and the act. While the other theories focus mainly on the action itself, virtue theory is all about cultivating a good character. Plato, the big name behind virtue theory, highlighted four key virtues: wisdom, courage, temperance, and justice, which came to be known as the cardinal virtues. Other important virtues include generosity, self-respect, and sincerity. Virtue theorists don't just want us to develop good traits. They want us to steer clear of bad ones like cowardice, selfishness, and vanity. At its core, virtue ethics is about fostering a strong sense of community, and that's where accounting fits in. The profession is a community bound by standards of excellence like those found in the AICPA Code of Ethics. Moral relativism is the idea that there is no one-size-fits-all answer to what's right or wrong. According to this view, everyone's moral beliefs are equally valid and no one person's opinions on morality is better than anyone else's. In other words, moral relativism says that there are no universal standards of good or evil. Instead, every judgment of right and wrong is shaped by an individual's preferences and the environment they live in. This approach moves away from fixed moral principles and leans into a more subjective way of making decisions. According to moral relativism, what's considered moral depends on factors like culture, religion, location, and the time period. Within moral relativism, there are a few key ideas: ethical relativism, cultural relativism, and situation ethics. Let's start with ethical relativism, which is often lumped together with moral relativism. It's the belief that what's right or wrong or good or bad isn't absolute. It changes depending on the person, the situation, or the society. For example, slavery, which we clearly recognize today as immoral, might have been seen as acceptable in different times and places. If ethical relativism holds, it means there is no universal standard to settle moral disagreements between cultures. That's why most ethicists reject this view, because even though cultures may apply moral principles differently, they tend to agree on the core principles themselves. Next, we have cultural relativism, which suggests that morality is based on the norms of a particular culture. In other words, what's considered right or wrong can vary greatly between societies. The same action might be morally acceptable in one culture, but totally unacceptable in another. So right and wrong aren't universal. They depend on where you are and the cultural lens through which you're looking. Examples include arranged marriages, which are acceptable in some cultures, or communal child rearing, which is common in some African countries. Then there is situation ethics, a theory introduced by Episcopalian priest Joseph Fletcher in 1966. This theory recognizes that certain moral principles exist, but it challenges the idea that they should always be applied rigidly. Instead, it suggests that the circumstances of a situation should influence the moral decision-making process. In other words, it's not about applying the rules without question, but about considering the situation at hand. A famous example of situation ethics comes from the story of Anne Frank and her family during World War II. The Frank family was hiding from the Nazis in a Christian family's home in Amsterdam. Imagine you're the person hiding them, and one day Nazi soldiers knock on your door demanding, "Do you know where the Franks are?" According to a strict interpretation of rights theory, you should tell the truth. But in this case, situation ethics might suggest that the moral thing to do is to protect the family, even if that means bending the truth. In other words, you're putting humanitarian needs above the letter of the law because the situation calls for it. As we wrap up today's presentation, remember, ethical dilemmas in accounting are not just theoretical, they're real challenges we face every day. By following the four-step process of defining moral values, identifying stakeholders, analyzing options, and making informed decisions, we can navigate these difficult situations. Integrity should always be at the core of your decision-making process. It's not just about following the law, it's about doing the right thing, even when it's difficult. Whether you're applying teleology, deontology, or virtue ethics, the key is making decisions that respect others, promote fairness, and stay true to moral principles. Ultimately, the six pillars of character, trustworthiness, respect, responsibility, fairness, caring, and citizenship, should serve as your ethical compass. Always remember, in the world of accounting, it's not just about the numbers, it's about doing the right thing for the public good.